Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host Sandeep Rao. In our last episode, we explored how to do a backtest using TradingView and Clock. Today I want to go off the course a bit and talk about something that has been a fairly accepted expiry day trading strategy revolving around far-OTM options. Famously known as picking pennies in front of a steamroller by people at one end of the trade and hero to zero trades by those at the other end. For a moment, forget about trading and listen to this parable as shared by Taleb in his book Black Swan. Consider a turkey that is fed every day. Every single feeding will firm up the bird's belief that it is the general rule of life to be fed every day by friendly members of the human race. On the afternoon of Wednesday before Thanksgiving, something unexpected will happen to the turkey. It will incur a revision of belief. I'm sure you understood the story. It refers to any returns profile of a strategy where there is a high probability of modest, consistent gain and a low probability of huge losses in any period. In other words, you will make a little almost consistently. And sometimes you will yourself find it hard to believe how is it even possible. But then one day the inevitable happens. You make such a big loss that you don't have anything left to play the game again. You are out. This phenomena has been called Taleb Distribution, a term coined by one of my favorite journalists Martin Wolf and the economist John Kay. But as someone who has been trend following for a long time, there is another return profile that looks opposite of Taleb Distribution. A string of small losses or break-even trades and then one massive profit-making trade. Statisticians call it the Holy Grail Distribution. It refers to a returns profile that produces small positive or negative returns centered around zero and occasionally gives outsized positive returns. So on one end of the spectrum, we have Taleb distribution, frequent gains and occasional big losses. And on the other end, we have the Holy Grail distribution that has frequent near zero gains or losses and occasional large wins. In the world of options trading, we see both of them come into play. Options allow us to express both these return profiles. On one end, we have penny option sellers or chillar option sellers as we call them in India. Taleb distribution is what applies to them. And then we have penny option buyers or the hero to zero players, and it's the Holy Grail distribution that applies there. But don't ask me why they call it the Holy Grail distribution. I really don't know. Let's move on. So what exactly are penny options or chillers as they're called? But before I explain that, a fair warning. To make sense of what I'm going to explain further, you would need to have a basic understanding of how options work and some bit about options Greeks as well. If you're new to options, I would highly recommend that you look up Zerodha Varsity or maybe attend one of the live courses before you watch this episode any further. Back to penny options. Penny options are option strikes that are priced at 1 rupees or 2 rupees that are far OTM and way outside the market's expected range, hence priced cheaply. For example, options that are 10% away from spot for Nifty monthly at the start of the month. In fact, there are many ways to select a far OTM option. One is price, the other is percentage distance from ATM or spot. Then we have delta and strike distance from ATM, all of that. Talking about distance from ATM or spot reminds me of the weekly ranges that we publish and we talk about in the weekly market metrics episode. You can have a look at the weekly market metrics sheet and get an idea of how much does the index move in a given month or a given week. And there's also an explainer video on it. You may want to have a look at it. I'll make sure I link it in the show notes. Back to penny options. In our examples here, I will stick with price as it's more intuitive and adjust the distance based on IV and more importantly, keeps the risk constant, especially in case of buying. Let's take some examples. Here I look at the weekly expiry options of Nifty at open on expiry day. I have selected strikes based on premiums closest to 2 rupees. The table below shows past 5 Nifty expiry days and the distance in terms of percentage that was there for a 2 rupee option. So on an average, the calls are approximately 465 points away from the at-the-money strike and the puts are just 350 points away from the at-the-money strike. Since November was an uptrending month, maybe that's why the calls are priced higher than the puts. Now let me also show you the distance of a 2 rupee option strike when the IVs are high, that is, when there's fear in the market. For example, let's take 7th April 2025 when Trump dropped the tariff bomb. Though 7th April was not an expiry day, it was a 2DT with expiry on 9th of April, Wednesday, as Thursday was a holiday and Nifty had Thursday expiry in April 2025. The 2 rupee call had a strike of 24,750 when spot was at 22,028. That's 2,700 points away, 12.35% from spot with 2 days to expiry. I tried going back to the historical data and I could only go back to 2650 put, which was trading at rupees 60, which was only 6.67% away. The market of course gapped down by over 5% that day, so you will have such crazy options premiums as well. So what does that tell us? How far OTMs and not just penny options are priced tells you how much fear is there in the market. To understand this better, you would need to know the concept of extrinsic value in options, which is made up of both time value and vega. Now, since we are so close to expiry, there is almost no time value left in this option, so all we see is vega. I'll again share a few links about it in the description, which will help you understand this concept better. Now that we've understood what penny options are, let's look at the two sides of the story. Penny option buying versus penny option selling. Another disclaimer. This is not a recommendation to invest, trade, or consider any of the mentioned products for future investments. Trading can cause complete loss of capital. For the purpose of the backtest, I have taken close prices as entry and exit unless mentioned otherwise. The returns shown include all charges, brokerage, and 0.25% slippage on both entry and exit. Let's start with penny option buying. I'll take a simple example. Every expiry, you buy 5 lots of 2 rupees worth of call and put and close it at the end of the day. Let's see what happens. This follows the holy Grail distribution. Many days of losses and a very few days of big wins. What do you see? Spurts of green but not big enough to cover all your losses. This is exactly like buying a lottery ticket, where you spend 10 bucks every day all your life and once in a few years you win 1k. If you could predict these green weeks and months, let me know in the comments. Now let's look at the other side of the coin. What if you do the reverse, that is sell 2 rupees options every expiry on Nifty? What happens then? Here we sell 5 lots of 2 rupees options at the open on expiry days and close it at 325, no stop losses. Do you see the difference? 2021 is a classic example of the turkey story. If anyone in their sane minds had traded this in 2021, they would have thought they have discovered a money spinning golden goose. This makes money month after month till it doesn't in June 2022. The Thanksgiving month of sorts for the goose. You can see the win rates are crazy high, but don't forget the massive losses in June 22, May and September 24 and April 25. What you make in 6 to 10 months, you lose in 1 month. In hindsight, the equity curve and the returns look good with so many green months, but it's not practical to trade such a strategy where one is taking the tail risk. The ROI is also quite low as the margins for 0DT to sell one naked strangle is close to 3.5 lakhs. This approach would have worked better in the past when 0DT margins were lower, but not anymore. But all the greens hide something, especially for novices and sometimes for experts too, that this strategy follows the Taleb distribution. You are winning consistently week after week and then one day you get bombed. There is no coming back. This has played out many times in the past, not just with retail traders but with large funds as well. So far, we've spoken about returns distribution, how they map to options buying versus selling, and we also looked at some real backtests. The next question to think about is there a strategic way of playing this game, or in other words, when does it make sense to sell or buy penny options? A little more than a year back, on 4th of June 2024, the election results day, it must be around 12:30 p.m., the market was down about 8% with the spot at 21,450 levels. I clearly remember that moment. The 25,000 CE that was 16.5% away from ATM, had 2 days to expiry and would expire on 6th of June, was trading at about 12 rupees. Call option was 16.5% above the spot. So if you believe that the market would not bounce back 16.5% within the next 2 days, that strike was worth selling. And that's exactly what played out. On 6th June, the expiry day, 25,000 CE expired worthless, with the market settling at a spot price of around 22,800-ish. Let me give you another example. I think it was 12th of May 2025. After the ceasefire announcement of Operation Sindhu, the market opened with a strong gap up. The spot was around 24,500 and the 23,000 put was nearly 1,500 points below spot, had 3 days to expiry, was trading at 5 rupees. This put option had a break-even of more than 6% away, so if you believe the worst was over and the market was unlikely to fall to 23,000 within the next 3 days, it presented a clear selling opportunity. And that's exactly what happened. The option expired worthless when the spot finally settled around 25,000 on 15th May 2025. Moving on to option buying opportunities, I'm reminded the Trump tariff days must be 4th to 7th of April 2025. The 21,500 put that was trading at 2 rupees, which was almost 1,400 points away from at the money at Friday close, became 180 rupees the next day at open. Buyers made 90x money and sellers would have lost very badly. Next, I remember the situation during the Operation Sindhu ceasefire, 9th to 12th of May 2025. There was a weekend, I think. Again, the 2 rupee call for a 6DT Nifty contract, which was around 1600 points or 6.5% away from the spot on 9th May, Friday close, went on to become 20 rupees by end of the day next day. Of course, all this data is cherry-picked to show the extremes, but that's the whole point. These penny options, when you buy them, have the characteristics of moving spectacularly on very few days, almost like lottery tickets. But that doesn't mean one should bet their house on them, because most of the time they lose. Selling them can generate consistent income, but just imagine what happened to those 21,000 P sellers on 4th of April. So it's kind of foolish to sell them as well. All of this is hindsight, and that's always 2020, and it's easy to say things in retrospect. In the heat of the moment, when panic sets in, making that decision to execute a trade can feel nearly impossible. But here's the key. If you have a solid system in place and you trust your strategy, it shouldn't be that difficult to pull the trigger when the time comes. So what do these examples tell us? Well, the ideal way to think about it is this. Assuming you have existing investments in the market, all that you need is to protect yourself from negative events, so that you can use the Taleb distribution to your advantage, and that would mean buying puts, if at all. Now, I'm not saying that buying puts is a great strategy. It's actually the inverse. But if you want to take a chance at capturing a black swan, then buying puts is one way. You have to be strategic about when you are buying puts and exit your puts to capture those gains, and that's very hard. Now, talking about penny option selling, well, you got to be selective in doing that too. Not all expiries offer great risk reward, but on weeks when IBs are high and premiums are bloated, you may want to look at the range stats and accordingly sell. Events that shake the markets offer great opportunities for seller, something we saw in the examples. Again, it's better to have a stop loss in the system if it's intraday and not to leave it to luck, or better still, play with option spreads. But consistently selling naked penny options is not something worthwhile, though the win rate may look enticing. Forget about retailers. There are enough institutional stories of perhaps the smartest of the folks who have lost money in this game. Look at the stories from LCTM debacle in 1998, where they lost close to 4.6 billion in a matter of weeks and Fed had to bail them out. or the collapse of XIV where the fund had to shut down as the Walmageddon of 2018 killed it. And more recently, on 5th of August in the US, VIX surged by 65% and touched 66, and S&P 500 fell more than 4%. The out-of-money puts like even 10 to 12% away strikes shot up massively in price. This sudden spike caused heavy losses for traders who were short volatility. Bottom line is, it's a very complex and risky game to play. On one hand, you have a payoff that gets you addicted to winning and then kills you one fine day, and on the other hand, you have another payoff that kills you every day a little, only to give you enough so that you start playing the game again. As always, trading is more about surviving to play the next day rather than being a hero. And being strategic with the approach and conservative with size is the only sustainable way to play this game. So that brings us to the end of this deep dive on trading penny options. I hope you found this episode valuable. Do share your questions, thoughts, and feedback in the comments. I'll try my best to respond. Thank you for watching and see you in the next one.